We may be familiar with accounting reference books such as Financial Accounting for Managers and Basic Financial Accounting for Management. And we might also know famous authors such as Jain and Narang. But the history of accounting itself begins with a book that was published well over 500 years ago. In the year 1494, the Italian mathematician Luca Pacioli published Summa di Arithmetica Geometria Proportioni et Proportionalita, which covers a variety of topics in mathematics and accounting. The book was groundbreaking in many ways as it introduced several accounting methods that are used till date, such as double entry bookkeeping, trial balances, balance sheets, and various other tools. Pacioli's book was widely successful and went through many reprints, spreading the knowledge of accounting methods throughout Europe. Now, one of the most important contributions that Luca Pacioli made was the accounting equation. This equation is the foundation of modern accounting as it represents the relationship between a company's assets, liabilities, and equity. The accounting equation is essential to understanding the flow of money in a business, and it states that the assets equals liabilities plus equity. It's a simple equation that may seem straightforward, but it's the backbone of every financial transaction that a business makes. But let's break it down further. Assets are the things that a business owns or controls, such as cash, property, or equipment. Liabilities are what a business owes to others, such as loans, bills, or debts. Equity is the residual value left over after liabilities are deducted from assets, and it includes things like owners' investments and retained earnings. One way to understanding the accounting equation is to think of it as a musical chord. Just as a chord in music consists of three notes played together to create a harmonious sound, the accounting equation consists of three components that work together to create a harmonious financial state. Just as a chord can be major or minor depending on the quality of the third note, the financial state of a company can be positive or negative depending on the relationship between its assets and liabilities. Just as a musician can adjust the quality and placement of the notes in a chord to create different moods and emotions in a piece of music, a company can adjust the quality and placement of its assets and liabilities to achieve different financial goals. Now that we understand the accounting equation and how it represents a company's financial state, let's take a look at how it fits into the larger framework of accounting. This is where the accounting cycle comes in, a series of steps that companies use to gather, record, and analyze financial information. Let's dive right in. The first step in the accounting cycle is to analyze the transactions and events. Analyzing transactions and events involves identifying and evaluating financial transactions and events that have occurred during a given period. The purpose of this step is to determine the nature of the transactions and events and how they should be recorded in the accounting system. To analyze transactions and events, accountants typically start by reviewing source documents such as invoices, receipts, and bank statements. They then classify the transactions based on the accounts affected, such as cash, accounts receivable, or accounts payable. Think of an accountant as a detective investigating the financial activities of a company. Just like a detective uses clues to solve a crime, an accountant uses source documents such as receipts and invoices to analyze financial transactions and events. Similar to how a detective classifies evidence, an accountant classifies transactions based on the accounts affected. The next step in the accounting cycle is to record these transactions and events in a journal. When a company engages in a financial transaction such as making a sale or purchasing inventory, it needs to record the details of the transactions in its accounting system. This recording process is called journalizing. To journalize a transaction, the accountant needs to follow a set of guidelines. First, the accountant needs to identify the accounts affected by the transaction. For example, if the company sells merchandise for cash, the accounts affected would be the cash account and the revenue account. Next, The accountant needs to determine the amount of the transaction and whether it's debit or credit. The debit and credit rules are based on the accounting equation, which states that the assets must equal liabilities plus equity. Therefore, if an asset account is increased, it is debited, and if it is decreased, it is credited. Just like a detective records every piece of evidence in their notebook, an accountant records every transaction and event in their journal. They make sure to include all the important details such as the date, description, and amounts involved. The journal acts as a record of all of the company's financial activities, and each transaction is recorded in a chronological order. This helps ensure that nothing is missed and that all the transactions are accurately recorded. The next step in the accounting cycle is to post these journal entries onto the ledger. This process involves taking the information from the journal and transferring it to the appropriate accounts in the ledger. Think of the ledger as a collection of individual accounts that track specific types of transactions such as accounts receivable or accounts payable. By posting the journal entries to the ledger, accountants can see how each transaction affects the company's overall financial position. Just like a detective might organize their evidence by category or suspect, accountants organize the transactions in the ledger by account. Each account has its own page in the ledger, and all transactions related to that account are recorded on that page. Posting the journal entries to the ledger is an important step in the accounting cycle because it helps ensure the accuracy of the company's financial records. By keeping track of all financial transactions in the ledger, accountants can easily see the company's financial position at any given time. The next step in the accounting cycle is to prepare a trial balance. Preparing a trial balance is like taking a snapshot of the company's financial position. It allows accountants to ensure that the total debits equal the total credits, which helps verify that the accounts have been accurately recorded in the ledger. To prepare a trial balance, all the accounts in the ledger are listed and their balances are calculated. The balances are then classified as debit or credit, and the total of debit is compared with the total of credits. If they match, the trial balance is considered to be in balance. However, if the trial balance is not in balance, it means that there is an error somewhere in the accounting records and the accountant must go back and check the ledger entries to find out and correct the mistake. As the detective, we have now collected all the evidence and put it into the ledger, but we need to make sure that everything adds up and there are no errors or discrepancies in the investigation. That is the point of preparing a trial balance. If everything is balanced, we can breathe a sigh of relief knowing that we have done a thorough investigation and have accurate financial records. But what if it doesn't? This is where we have the next step in the accounting cycle, which is adjust entries. After preparing a trial balance, the detective or accountant may find that some accounts are not quite accurate. This is where adjusting entries come into play. Adjusting entries are made at the end of the accounting period to correct any errors and ensure that the financial statements accurately reflect the company's financial position. Just like a detective might need to gather more evidence or re-interview witnesses, the accountant may need to make sure that any additional adjustments that need to be made are made to the accounts. For example, if a company has prepaid rent for the year but the rent expense is recognized each month, an adjusting entry would be made to adjust the rent expense and prepaid rent accounts accordingly. This ensures that the financial statements accurately reflect the expense for each month. So, just like a detective needs to ensure that all the evidence is accurate and complete before making a conclusion, the accountant needs to ensure that all accounts are accurate and complete before preparing the financial statements. Now, when they are ready, we move to the next step in the accounting cycle, which is the adjusted trial balance is similar to the trial balance, but it includes the adjusting entries that were made to the accounts. This step involves taking the balances from the adjusted ledgers accounts and listing them in a table format. The adjusted trial balance is prepared to ensure that the total debits equal the total credits, just like in the trial balance. However, the difference is that the adjusted trial balance includes the adjusting entries made at the end of the accounting period. Once the adjusted trial balance is prepared, the accountant can use it to prepare the financial statements for the company, including the income statement, balance sheet, and statement of cash flows. It's important to note that if the adjusted trial balance does not balance, it means there is an error in the accounting records and the accountant will need to go back and review the records to identify the error. The financial statement is where all the information gathered from the previous steps is compiled and presented in a clear and organized manner. Just like a detective presenting evidence in a case, the financial statements serve as evidence of the financial health of a business. There are four main financial statements: the income statement, the statement of retained earnings, the balance sheet, and the cash flow statement. The income statement shows a company's revenues and expenses over a specified period of time, typically 1 year. It calculates the company's net income or net loss. The statement of retained earnings shows changes in a company's retained earnings over a specified period of time. Retained earnings are the portion of a company's profits that are kept by the company rather than distributed as dividends. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It shows the company's assets, liabilities, equity, and provides a clear picture of what the company owns and owes. Finally, the cash flow statement shows how much a company has generated and used during a specific period of time. It provides insight into a company's ability to generate cash and manage its cash flows effectively. Overall, the financial statements are crucial tools for businesses, investors, and other stakeholders in assessing the financial health and performance of a company. Now that we have prepared the financial statements, it is time to close the books. This is where the company formally closes out its accounting records for the period and prepares for the next accounting period. To continue with the detective analogy, closing the books is like putting away all the clues and evidence after a case has been solved. The detective can now move on to the next case, just as the company can move on to the next accounting period. Closing the books involves several steps, including closing revenue and expense accounts, closing the income summary account, closing dividends, starting the next accounting period. Closing the books is an important step in the accounting cycle as it assures that all accounts are properly updated and ready for the next period. It also allows the company to determine its overall financial performance for the period and make informed decisions moving forward. And that is a wrap on the accounting cycle. I hope you enjoyed our journey through the accounting cycle and the accounting equation. From analyzing transactions to closing the books, we've seen how accountants use this cycle to keep track of a company's financial health. And accounting may seem like a lot of work, but it's a crucial part of any successful business. By following the accounting cycle, companies can make informed decisions based on accurate financial information. That's my time. Thank you for watching.